Well, thank you very much. It's a real honor to be part of this program again for the second time in 2 years. I really appreciate the opportunity, and this is a very distinguished group of leading bankers in Asia and elsewhere, as well as economic thinkers. So it's a privilege to be part of this organization. I'm going to come at today's topic from the standpoint of a banker and a bank regulator. So one aspect of my background that wasn't mentioned is that I was the primary regulator of the U.S. national banking system and was a board member of the Federal Deposit Insurance Corporation in the United States. And so a lot of what I say will come from the perspective of ways that artificial intelligence challenges aspects of the bank supervision paradigm and ways that it suggests the future might unfold once that paradigm is behind us. So let me begin by talking about how that paradigm currently works in the United States, in most of the G20 countries. So the core element of financial supervision has tended to focus on the intentional or negligent behavior of people and institutions. And the way that we shorthand this is the idea that the regulators always need to know whose throat to choke in the event that a loan goes bad or a bank fails or there's some aspect of mismanagement that occurs inside of an institution. Artificial intelligence obviously challenges that, because what AI does is algorithmically learn based on observations of large amounts of either language or data in ways that are not necessarily envisioned by the programmers of the algorithm. And so there may not be a person who did anything wrong. There may not be an institution that intentionally made a choice to do something risky or to do something unlawful. And that is difficult for bank supervisors to think about. There's also a subcomponent of the traditional financial supervision framework that is challenged by AI. And that is the idea that financial decisions are legitimate as long as the institution can give reasons for the decision. So if you think about the simplest thing that any financial institution does, it's to grant or deny credit. There are lots of other things banks do, but at the core, banks are lending institutions. And one way that financial supervision tends to work almost everywhere in the world is based on the idea that if a bank denies you credit or offers you credit at unfavorable terms, it has to tell you why. And historically, the banker knew why. It knew that your debt to income ratio was off, or it knew that your cash reserves were lower than the amount that the bank normally required. And it could tell you that, and you could accept the decision as legitimate. But again, in an AI environment, multiple factors are being considered in balance with lots of other factors, and there may not be any one reason. And the institution deploying the AI algorithm may not be able to tell you a specific reason why the outcome was what it was, even though they can tell you that the model is highly predictive. And so these things are very challenging for people who regulate the banking system. Now, I'm going to argue today that on balance, AI, as we've seen it deployed thus far, has been a positive for the financial system in lots of ways. I'll talk about that more specifically in a moment. But at the same time, there are real reasons to be concerned that the tools we have for banking regulation and supervision today are not up to the task, won't be able to fully identify, manage, and constrain risk in the system the way they can when fallible human beings are making the decision. Let me talk for a moment about what I see as the key areas of deployment of AI. In other words, where the biggest commercial uses are in financial services and why those are attractive. And then I'm going to turn from there to where the key risks are. But let's start with the positive story. And I'm going to, you could focus on lots of different things, but I'm going to focus on three in particular as highly optimistic reasons for believing that AI will be good for the system. So the first is in the area of credit, which I mentioned just a moment ago. The interesting and dirty little secret about credit is that no credit model that is used by a lending institution can perfectly capture all of the aspects that predict future repayment of a loan. And indeed, some of the best credit predictive models in the world only capture around 60 or 65% of actual credit performance. So if we think about what that means in today's status quo, it means that a significant amount of the time, the credit models that we use are either approving loans that will default or are refusing loans that wouldn't have defaulted had they been made. And both of those represent deadweight losses in the economy. So in a perfect world, every loan that would repay would be made, and every loan that would default would be denied. But that's not the world we live in, even under the most sophisticated of manually built credit models that are in use today. Enter AI. The concept of AI is that if an algorithm can examine a large portfolio of loans, it will see reasons why certain loans that were thought to have performed well didn't, and it will also perceive the opposite, and it will begin to correlate those and learn things that may not have been identified by the humans who built the original models that made those loans or denied those loans in the first place. And eventually you may get to a place where instead of capturing only 65% of credit performance, we can capture 99% of credit performance, meaning that we will simultaneously be able to make every loan that should be made, including loans that are denied today, and deny every loan that will fail, including loans that were inadvertently made today. And you would think that that would be an obvious and unvarnished positive for the economy because all deadweight losses would be eliminated. Now, as I'll point out in a moment, there are actually some unintended consequences of this kind of a world. So one common way of thinking about this is as follows. One of the things we care about in credit is that loans be made only on the basis of creditworthiness and not on the basis of impermissible factors like race, gender, social network, background, or things like that. But it's very possible in a world that both has an unequal distribution of wealth and income, but also has an AI-enabled, highly predictive credit model. It's very possible that we could both increase the absolute numbers of underserved people getting approved for loans by capturing racial minorities, gender minorities, or other groups that are currently excluded and include them by making them the loans, but at the same time, increase the statistical disparities between these groups because of the underlying unequal distribution of wealth and income. And so how do we feel about that? I'll talk more about that in a moment, but the point is that credit predictiveness is something that the status quo does very poorly. Global credit markets are, the largest segment of the global economy, and anything that eliminates deadweight losses and ensures that credit get allocated on the basis of future repayment has economic upsides and potential social dislocations. And we have to balance both the positives and the negatives of that. Let me turn to a second key area of deployment of AI, which I think also has the attention of regulators, particularly in wake of some of the banking failures of the last 12 months. And this has to do with making macro predictions. So if credit models in AI are about micro predictions, in other words, will this individual repay a loan or not, dealing with the banking system itself is more about macro predictions, which is to say, what will the interest rate environment look like? What will the valuation of securities portfolios and other assets held on bank balance sheets look like, and the like? That's important because banks have to not only manage individual credit performance, they also have to manage their overall balance sheet. And if you think about the most famous of the recent bank failures, the failure of Silicon Valley Bank 6 months ago, what you remember is that bank failed not because its credits were bad. It failed because it had inaccurately predicted the macro environment and had held a lot of long-dated, low-interest rate assets on its balance sheet and had a lot of short-dated, high-interest rate deposits on the liability side of its balance sheet, which led to a bank run. You can imagine a world where AI, which is learning from historical interest rate environments, would do a better job of predicting what's going to happen in the bond markets and more generally in monetary policy than the individual managers of one mid-sized bank were able to predict. And thus, in the same way that it could help them avoid making risky individual loans, could also help them manage a balance sheet that is highly affected by interest rate risk. This is another area of deployment where AI has the chance to really transform the way that we manage risk inside of a bank. The third area, and again, I could list 15, but I'm trying to just illustrate a point here. So the third and final area that I'll talk about has to do with fraud detection. So one of the most important things that happens in our financial system is the use of finance for things like money laundering and other fraud that isn't an intentional part, but is a predictable byproduct of anybody who's engaged in taking deposits, making loans, or engaging in payment processing. Today, the fraud detection system we have in the global financial system is highly manual, and it largely depends on individual financial institutions filing suspicious activity reports when individual bank employees believe that some policy has been triggered, and then depending on government and law enforcement to either follow up or not follow up on those SARs. What we know from various scandals over the last 2 or 3 years is that the manual suspicious activity report environment that we operate is filled with false positives. The vast majority of SARs don't actually indicate fraud at all, but the volume of SARs is so large that it's almost impossible to detect real fraud, which represents a small handful of needles in a gigantic global haystack. That's a problem. AI offers the possibility, and there are a number of commercial AI providers that have built these solutions, to forget the haystack and only focus on the needles by doing correlation analysis. One of my favorite startups that I once worked with in this space had an algorithm that was able to find bad guys not only by sorting through large amounts of transaction data and internal and external email and messaging data, but also to look at correlations and behavioral patterns in things like travel records or calendar entries. And in one famous case, a particular AI-enabled fraud detection startup was able to unravel the source of a fraud by identifying that there were 2 lunch dates made by 2 people inside a bank who had never had a calendar invite together ever before or ever after in their career at the institution, but only on these 2 occasions did they calendar a lunch. That was thought of as suspicious, and it did turn out that those 2 people had conspired to essentially steal money from the institution. And that's a pattern recognition prediction that would have been highly unlikely to be caught had we relied on manual tools. So you can see that these 3 illustrations are just an example of how AI significantly transforms the way that financial operations exist and financial compliance happens in ways that are likely to be very positive for the system. But at the same time, I want to turn just briefly to the risk factors involved in these kinds of deployments. And unfortunately, the list of risk areas that I was able to come up with just in preparation for this talk is a lot longer than the risk of positives. So we need to take this all very seriously. So the first risk area has to do with model risk management. I think most people in this room know that banks and broker-dealers depend very, very heavily on being able to use financial models, not just for credit underwriting, but for lots of other things that they have to make decisions on inside of the institution. And bank regulators require, if you're going to use a model, that you use model risk management to make sure that the model is well fit to the risks it's trying to manage, that it's predictive if it's trying to measure future behavior of borrowers or anybody else, etc. But those rules around model risk management were crafted at a time when there was a committee of people led by a risk officer who were making individual judgments about what factors led to risk and how those risks would be managed. Again, in an AI environment, both the benefit and the detriment of AI is that it learns from large amounts of unstructured data. And so on the one hand, you could say that the current AI model is producing results that are more predictive than the previous manual model. But if you can't explain why, and if you can't get comfortable that this model's fit will persist into the future, then regulators are going to have a hard time believing that the risk that the model is intended to manage are being appropriately managed. They want to know the reasons, not only the outcomes, and that is an inherent problem with any learning model, which is basically what AI is all about. That's one risk area. A second risk area that's fairly obvious is privacy. The way that AI models work is that they are trained on a data set. And the data set consists of, depending on the kind of AI that we're talking about, large amounts of transaction data, potentially including your transaction data that you may not have consented to. It may include large language models, including articles people have written that may be subject to copyright, or emails that people may have written and had an expectation of privacy in, or whatever. It's very difficult to get every single person whose data is included in a model to consent to the use of that model. And yet, when the AI algorithm is being trained on that model, the outputs will be heavily dependent on what went into it. And that affects all of us whose data was used for that purpose. And so getting privacy right is a major regulatory challenge here, as is the third item on the list, data security. So institutions are all subject to rules around how they manage the security of data that they house inside of their systems. But when you let loose an AI algorithm on that data set, the AI algorithm itself may not be containable in the same way that the inert data or the unstructured data itself was. And because that model is now being used for decision making, the idea could be that the model and its output getting hacked could allow someone to reverse engineer what went into that algorithm in the first place. Which brings me to the fourth risk issue, governance. Almost everything I've talked about today is the reason why all companies, not just financial institutions, are expected to comply with various governance standards. There needs to be a management team with clear lines of responsibility. There need to be committees with charters describing their authorities. There need to be delegations of authority policies, and there needs to be a board of directors to present credible challenge. The problem is none of those concepts mean anything in the world of automated decision-making by an AI bot. And so the question becomes, if you truly have artificial intelligence that is basing its decisions based on things that are predictively fit, but that weren't determined by an individual or body of individuals, what does the concept of governance even mean? And so again, we're challenging paradigms here. We're not just making incremental changes to the way the world works. And finally, the last risk issue that I wanted to just set the table with here has to do with compliance, and especially consumer compliance. This gets at the issue that I noted a moment ago having to do with credit and lending, which essentially asks the question, how do we feel about something where we are highly confident that the model is making the right decisions, and yet that decision reveals uncomfortable truths, for example, truths about discrimination or inequality? How do we feel about a model that we think is making the right decisions, but we cannot articulate the reason for those decisions, or the reasons for those decisions are predictive and yet uncomfortable? A classic example of here turns out to be that credit performance is heavily correlated with social networks. People who have a lot of friends who have defaulted on loans are much more likely to default on loans than people whose friends haven't defaulted on loans, all other things being equal, because one reason we pay our obligations is because of social stigma. So if it turns out that social networks are highly predictive of credit performance, do we believe as a society that it is okay to consider that factor because it's predictive? Or would we rather have a less predictive model because it seems unfair or it seems unjust to deny people credit simply because their neighbors have defaulted on loans? These are difficult questions that have not yet been grappled with in the open, and are questions we will have to deal with as a society, as a community of bankers and regulators if we're going to go forward. I'm going to close just briefly by saying that the US has certainly not gotten this right yet, but the timing of this discussion is very apt, since just this very week, the Biden administration has released its executive order on artificial intelligence. That order covers much too much territory for us to deal with in any kind of a comprehensive way in this session. But I would encourage people to just look at the headlines of it, because what you will see is a lot of it is designed to tease out the kind of social justice issues that I've identified here. A lot of it says, we don't want to use AI if it produces discrimination, even if the AI is correct. And so it tends to suggest that if we had a very predictive credit model that exacerbated racial disparities, we would rather use a less predictive credit model than a more predictive credit model. And that may be the right outcome that society can tolerate, but it's not an obvious outcome. We've seen the same thing with the predictive analytics rulemaking that our Consumer Financial Protection Bureau released a couple of months ago. The CFPB, which is one of our several financial regulators in this country, is of the view that even if you have a very predictive AI model for credit, if you cannot identify the specific reason why the model denied credit in a given case, then you have to revert to a manual model, because the overriding principle here is not credit predictiveness, but the ability to articulate reasons. And that, a sense of fairness in a free market democracy demands that reasons be able to be given. And one of the features of AI is that it's learning from lots of sources, and it's very hard to tease out a single reason for almost any decision. So I'm going to pause there, and I'll turn it over to my fellow keynote speaker and then to the panel. But the point is, and I would just close on the idea that AI is a challenge to the basic paradigm of financial regulation, not just an incremental change, and that thinking through the trade-offs between economic outcomes on the one hand and social policy on the other hand is something that no government has yet grappled with in a comprehensive way. Thanks very much for having me. It's a real pleasure to be here today.
Thank you very much.